All right, why don't we get going? So thank you very much for joining. So my name is Mark Lamonic. I look after the individual investor business for Morningstar in Australia. And first, couple of housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can go to our website, morningstar.com.au, get a copy of our FAP, and also the New Zealand regulatory authorities, which is appropriate for today's discussion, would encourage you to go seek out a financial advisor if you want personal advice. So anyway, this is webinar 2 from on vacation. So please, I apologize again for anyone who tuned in on Tuesday with the weird internet outage and the loud boom, but we're hoping that doesn't happen today. But anyway, let's get started. So obviously you can always listen to our podcast or follow us on Instagram. So we're going to talk about financial advice today, but we're also going to make this practical because I don't think people want some theoretical discussion about financial advice, but it is important to frame what is happening in Australia right now with the financial advice industry. So number one, there's been this huge exodus of financial advisors. So I think everyone remembers the Hayne Royal Commission uncovered a lot of not so great behavior by certain firms and certain advisors, and a number of reforms were implemented off the back of that Royal Commission. And what we've really seen is 2 impacts from that. So we've seen, number one, a huge reduction in the number of financial advisors. And we'll talk about some of the reasons. And also, unsurprisingly, we've seen a huge increase in fees. So a lot of the regulation that was put in, whether right or wrong, it's not up to me to have an opinion on that, but a lot of the regulation that got introduced has made it harder to be an advisor. So number one, educational standards were upped, and many advisors had to sit for an exam or have to sit for an exam in order to still practice, and many have chosen not to. So it was an industry that skewed towards the older side. And I think a lot of people just saw all of these reforms and all of these new hoops they had to jump through and decided that, okay, maybe now is not the time to continue my career and I can stop. And there has been also a very small amount of new advisors come onto the market. So the last stat I read is, there is something like 900 people that are currently in a degree program that will allow them to be a financial advisor. And the industry is losing thousands and thousands of advisors every year. So there obviously is a little bit of a problem with replacing advisors as well. The other thing, obviously, you can see that the fees have jumped. So with less advisors, with significantly higher fees, the number of advised Australians, of course, has fallen and will continue to fall as we lose advisors into 2023, where that estimate is that we will have half as many before the Royal Commission. So not a great time if you are seeking out financial advice in Australia. So what has happened? Well, one thing that's happened, of course, is to fill the gap, people have turned to different places, and particularly younger investors who have turned to social media. And there were a lot of complaints about what was going on social media by me as well as others, because you often had people turning to individuals that really had no qualifications, had no experience, and were, of course, offering up recommendations on certain investments. And there was an asset crackdown relatively recently that occurred with this that has really limited what a so-called finfluencer can actually say. So really removed a lot of the, removed any discussion of financial products, removed a lot of the ways that these influencers made money, and they generally made money through referrals, so referrals for financial products. And that has all gone away. And because of that, a lot of the finfluencers have, of course, gone away. So I don't think that's necessarily a bad thing, because as I said, not really qualified and don't really have any experience to provide the advice that they're given. But it doesn't change the fact that there is a pretty severe lack of financial advice resources in Australia. And particularly with sort of the regulatory environment here, it is very difficult to even get a general advice license, which is what Morningstar has, in which I always give that general advice warning. And then specifically, if you were trying to get a personal advice license, there are a lot of hoops to jump through, and there's nothing really in between. So there isn't really a regulatory framework right now that can offer up sort of scaled advice. And people are clearly fairly worried about this. So we'll see what happens as we go forward. But this is kind of the landscape we're in. And so what I wanted to spend today talking about is, what are the main benefits of financial advice and where can we all get them, or how can we do it ourselves? So namely, we'll talk about how we can do it ourselves. So people obviously certain people are still willing to pay financial advice fees, but realizing if you are paying $3,256, you need to have a very large portfolio to have that make any sense. If you do not have a significant portfolio, you are going to be hard pressed to make up that value. So that's the context as well. All right, so let's start with what are the benefits you get from financial advice and how can we actually get those benefits without using an advisor? And I do want to say that, this is nothing against advisors. Morningstar and me personally think that there are a lot of benefits from going out and using an advisor. But once again, within this environment that we're in, there isn't really a way to access affordable financial advice for many Australians. So we're sort of focused on, okay, what are the different ways we can do this without an advisor? So the first thing is, of course, start with a plan. And so you hear all the time on these webinars that we talk a lot about a plan. And I think that that is a great part of financial advice, that the start of everything, of course, is a plan. Now, we have very specific thoughts on what that plan should be. Once again, we think it should be a goal-based plan. We'll go through some of these specifics, and should not be simply a compliance tick-the-box exercise to get you into investment. So if you are working with a financial advisor, and the first thing they start talking to you about, or very quickly start talking to you about, is actual investments, that is a little bit of a red flag. We want to start with you, of course. And so the saying that we always say that we want to start with the investor and not the investment. So you can create a plan just like an advisor can on your own. But many people struggle with doing this. I think they struggle with a couple different steps, which we'll go through. So just know that you can do this yourself. You can create your own financial plan. It's just going to take a little bit of work. So the first thing that we believe you need to have in a good plan is it needs to be goal-based. So this is what we talk about all the time, that, the focus from a regulatory standpoint, in order to provide personal advice, one of the ways that you can do that is you can focus on someone's risk tolerance. And your risk tolerance, of course, is how much risk you are, quote unquote, willing to take on. So the way that risk tolerance is measured is it's measured by a risk tolerance questionnaire generally. So they'll go through, they'll ask you a bunch of questions. All the questions on what would you do if certain things happened in the market. If the market fell by 20%, would you invest more? Would you do nothing? Would you sell everything and hide it under your mattress? So we often have these risk tolerance questionnaires. We do not believe that that's the approach you should take. We believe you should focus on your risk capacity, which means goals and how much risk you have to take on to achieve those goals. So I'm not going to repeat all the stuff that we do in other webinars, but we do have a lot of goals-based webinars and podcasts and a portfolio construction guide that go through these different steps, and a number of tools on Morningstar Investor as well to help you set a goal. And the biggest issue that people have is this second point right here, is being specific about it. And so I think one of the good things about financial advice and a financial advisor that does focus on your goals is you have to answer these questions. So you are sitting down there and actually trying to define what you want your future to look like. And by defining it, we mean that you need to get very specific about when you want to achieve your goal, how much it will cost, and then how much you can save every month. So those are all really important steps. And people are reluctant to do this. And I think people generally sit there when they're looking at when they're looking at goals and they're looking at their future, and they describe it and think about it in very non-specific terms. I want to have a great retirement. I want to travel during retirement, but don't actually have the specifics documented, which enable you to actually come up with a plan that's based on you. So go through, spend the time to document it. And once again, remember that perfection sometimes can be the enemy of progress. Your plan can change. It's likely your plan, if you are younger, your plan will change a lot over the years, but putting that stake in the ground is really, really important. And it's important because when your circumstances change, when you hopefully get a raise, when you are trying to make a decision to maybe go into a different career where you may take a lower paying job for a while, all of those decisions will have a framework and context around them, so you know how those will impact your financial plan. And you can adjust this obviously over time, but putting that stake in the ground is really important. Then once again, after that, we can focus on the return you need to achieve, right? So this is why we don't like risk tolerance questionnaires. We don't like risk tolerance questionnaires because they are in no way focused on your goal. They are focused in your perception of risk and your perception of how you will behave when there is market volatility, which is what you're worried about. Now, we don't like them, number one, because they're not accurate. So we as humans have a very difficult time assessing how we will respond to risk, to fear, to greed. We generally do not know how we're going to respond to that stressful situation. That's number one. It doesn't take into account your goals. And what I always say during these things is, there's study after study after study where these risk tolerance questionnaires, based on your gender, you get very different outcomes. And that shouldn't be, right? Because if you look at the aggregate, men and women should not have different goals. But because we're just focused on how much risk you want to take, we get very different outcomes. So whether that's women naturally being more conservative in that environment or men naturally being more aggressive in that environment, either way, we should not have different outcomes and different investments based on gender. And that's what those risk tolerance questionnaires keep going. Another reason why it's inaccurate. So focus on the return you need to get, and then an appropriate amount of risk for you to take based on that return. So of course, when we are investing, it is just a risk and return trade-off. So when we talk about risk, we're talking about volatility, how much an investment is going to bounce around. So when we take on more volatility, we should get higher returns over the long run, meaning shares should have higher returns than cash. In a very simple example, they bounce around more in price. We've certainly seen that this year, but over the long term, you should get higher returns. But you need to take on enough risk to actually achieve your goal. Next, so an investment policy statement. The other part of your plan that's really important is not just laying out your goals, your asset allocation, and the amount of risk you need to take in, that return you need to earn, your asset allocation. There are things to lay out your investment strategy and the approach that you're getting to take to selecting investments. And this is really, really critical because once again, this brings structure. And we'll talk a little bit more about structure later. But by actually writing this stuff down, it forces you to think through it. And this does not need to be, and when we talk about a plan, this is not an enormous document. You can do this very easily. We're actually going to release in 2 weeks as part of Morningstar Investor, a new template to help you go through and define an investment policy statement. And what you'll see when this thing comes out is that it's very small. It's just listing what is the approach, what's your strategy. So your strategy could be, I'm going to invest passively using ETFs with a focus on low cost ETFs. Be very, very, it can be, very, very minimal, but just going through and defining that is really important. So all of this is something you get, of course, with an advisor and for regulatory purposes. You need to get a statement of advice from your advisor. And a lot of it, if you sort of strip out all the regulatory stuff, a lot of it is just this. What are you trying to achieve? When do you want to achieve it? How are you going to do it? So that's your asset allocation, and that's this IPS. That's the first thing. And we can all do this. There's nobody out there And obviously, we have a lot of tools and resources to help you at Morningstar, as do other places. There's nobody out there that cannot put together a plan. It just takes a little bit of effort and takes a little bit of thinking about what you want your future to look like. And what the benefit of doing all of this is obviously it provides some structure, but it also allows you to know what's achievable. Because depending upon when this plan is going to happen, there's all sorts of different things that you can do to make sure something's achievable, namely save more money and at least understand the trade-offs that you're making when you're choosing spending versus saving. And that's what a plan can allow you to do. All right, another huge benefit that you get from an advisor is behavioral coaching. So we talked a lot about this on Tuesday for anyone who joined in, and if not, you can go watch that on YouTube. But we talked a lot about, what happens when we have volatility and people make poor decisions and the implications of those poor decisions. So one big thing that we talked about Tuesday, we talked about the Morningstar Mind the Gap survey, which is looking at the difference between returns investors get and the returns that investments get. And so in the latest one, and what we talked about was, there's a 1.7% gap. And if that doesn't sound like a lot to you, go find a financial calculator and look over a long term what 1.7% is. It's a huge gap in the amount of money you end up with. And that gap, of course, between the returns that we get as investors and what the underlying investment gets is due to poor timing decisions. So basically poor decisions by us. So of course, investing when we're at the top of the market and selling when we're at the bottom of the market. And that's another reason why risk tolerance doesn't really work, because our risk tolerance actually changes. And unfortunately, it changes in the opposite way that it should. So when markets are doing really, really well, we perceive them as being safer, but in fact, they're not, right? If you have a long string of above average returns, that is not a safer market. That's actually a market where you're going to have to get below average returns to get back to average. But we perceive the market as safer. And so sort of the combination of that perception of safety, as well as, of course, just the fear of missing out and hearing about the returns everyone gets, causes people to really pile in at the top of the market. And we see this every single time that there's a crash. We see this huge surge, and generally from retail investors, this huge surge of money that goes into the market. And we've seen it this year too. So in this year, if we are in fact at an inflection point, we've seen a bunch of institutional and professional money come out of the market. And we've seen a bunch of money from retail individual investors go into the market. And this happens every single time when you're at a market top. And sort of famously happened in the year 2000, where insiders, tech insiders, institutional investors were selling while individual investors were buying. And of course, the year 2000 is when that market drop started and then sort of accelerated through the next 2 years. So behavioral coaching, we're talking about how we can actually prevent ourselves from making these mistakes. So there's two ways that advisors do this for you. Number one, of course, it's the structure of having a plan, which we talked about before. So that structure is really important. Like all of us, what we're trying to do as investors is we're trying to act more rationally, and having a plan can act as a little bit of a speed bump that you can go back and revisit. The other thing, of course, is you have a financial advisor, they're a sounding board that you can go to, and they can talk you out of it. And one of the interesting things that's happened, if we go back, even pre that 2000 crash, a lot of friction has been removed from the investing process, right? So if you go back into even the mid 90s and you wanted to make a trade, you had to pick up the phone and call your broker and explain to them what you wanted to do. And then they would make that trade for you. Then when we started having the internet bubble start accelerating, of course, one of the drivers of that, or one of the enablers of that, was the fact that now you could trade online. So you didn't have to talk to anyone. You could sit in your home, in your dorm room, if you were me, and you could, of course, just log on to a website and you could just trade online. And That, of course, is great. Removing friction from the process, of course, hopefully helps more people become investors, which is a good thing. But the problem is that there is nobody to talk to. There is no speed bump to stop you from doing something stupid and just trade on a whim because you're worried about something or somebody tells you some stock pick. There's nothing preventing that. And what we've seen now, of course, is we've seen an acceleration of that, where in many cases, brokerage now is either free or perceived as free. So we've seen brokerage come down with a lot of these fintech companies. And even though, if we talk about some of the quote unquote free brokerage of trading internationally, it's not free. You're paying huge amount in FX to exchange your money, but people still perceive it as free. So we've removed another piece of friction. And now, of course, you can trade from your phone. So you don't even have to be sitting at home in front of your computer. And once again, there are benefits to this, but we need to remember that we are removing any sort of sounding board, any sort of friction, which makes it easier for us to make these poor decisions. So, all right, so how can we replicate this benefit? I went through a fair amount of it. So talked about a plan, an IPS, but then when you are making specific investments, so within this investment policy statement, you should sit there and talk about the criteria for what you're going to invest in. But then when you're making specific trades, and I know that this sounds horrible to people, but write down why you're doing it. So if you write down that rationale and you document what could go wrong, why your thesis on a certain share or ETF could be wrong, that adds some structure. So number one, it will prevent you from doing things on a whim. And there is no reason with investing why we should ever do things on a whim. I know we get caught up because you see, of course, security prices moving around a lot and think, okay, well, I better get in here as soon as possible. But in reality, that's not going to matter over the long term. So what we want to do is we want to slow down that process. And slow down that process will actually hopefully make it a little more rational. So yeah, write down these reasons. And then when there's volatility and you want to sell an investment, go back and read those original reasons. Once again, that will slow down that process and make you think a little bit about why you invested in this in the first place and if that thesis still holds. And this will help you learn. So we're all learning, right? Constantly learning as we become investors, but simply documenting stuff and going back and reading it again, you're going to make mistakes. We all make mistakes, but that'll actually help you learn from them instead of just forgetting them. Another thing we can do is we can use our required rate of return as a means of judging progress towards a goal. One of the big problems with investing that I think is underappreciated is that compounding, which is a good thing, and we always hear about, the compounding also means that most of your returns will occur in the last years as you're approaching a goal. It's just the way it works. So the way that we traditionally measure how we're doing by looking at our account balance, by looking at sort of the returns we're getting on a yearly basis, isn't really that effective. Because number one, people can give up because it doesn't feel like you're getting towards your goal, but you have to go through those tough early years where you're turning $10,000 into $12,000, et cetera, to get to the point where you can get those outside returns when a decent return will actually mean a large dollar increase in your account. So really, really hard to judge progress. So use that required rate of return and use it because it will actually tell you what to do. So required rate of return is what gets you from where you are to where you want to be. If the market falls significantly and your account falls significantly, your required rate of return will go up. And we know, of course, that if it's more, if we need a higher return, we can't get more conservative, right? We need to take on more risk. So I'll actually show you what you should do instead of people looking at their account balance who will panic and want it to stop going down and will sell to sort of stop that pain of watching the account balance drop. Same thing on the upside. So right when we've had years of outsized returns, that required rate of return will go down. And that should show you that, hey, maybe you don't need to jump into crypto when it's at $60,000, right? When Bitcoin's at $60,000, it'll tell you, okay, well, maybe I can actually take on less risk and I can ignore this fear of missing out and all these returns I'm hearing about. I can ignore that because I'm making progress towards my goal. maybe now's the time to build a little cash because the market's actually pretty high. So yeah, it's a good way of judging your progress against your goal. And that's sort of why we built that feature in your premium, where you can check what your original required rate of return is and then what your current one is. The other thing, and this is hard because nobody wants to talk about money, find a friend or a family member that you can use as a sounding board, someone to talk through stuff. And they don't have to be, and obviously it's helpful, they don't have to be some, investment genius who's really knowledgeable, but just the act of explaining to somebody. So after you write it down, explain to somebody why you were doing something. It will help. It will help, once again, to put a little speed bump in there to make sure you're not doing stuff irrationally and just on a whim. And it will also help to clarify your own thinking, right? Anytime, what we always say is that the test of knowing something is being able to explain it, right? So same thing. So that will act as a way to make sure that what you're doing is actually rational and thought through. And we want that structure, and we want to be thoughtful investors. So I do know that that one is hard because people don't like talking about money, but it can be really effective. What happened to, well, I had another slide in here. I'll just talk through that other one. I don't know what happened to that. Maybe it's just me forgetting things on vacation. But the other really important thing to do that an advisor can look at for you is to take a total wealth approach to your portfolio. So total wealth approach means that good financial planning is more than just simply looking at your portfolio, right? Good financial planning is taking your whole life and taking a holistic view of your life and using that to help make different decisions. So it is something that's really important. So what that means is you got to focus on a couple different things. So one thing is your career. And thinking about, okay, what is my career? How am I compensated? What are the drivers of, one, my job safety, and two, compensation changes? And a simple example is I can obviously use myself. So, in my case, of course, because of Morningstar and because of what Morningstar does, the performance of markets certainly have an influence on how our company does. And so, looking at that holistically, makes you realize that, okay, well, it is a situation where I can't have my job be very focused on share market returns and then put all of my other assets into share market returns. Not a great situation, right? Because obviously if things go very south, that could impact my compensation or my employment. Could also impact, of course, my portfolio. So not great. See the same thing in real estate, right? That people who are real estate agents love to invest in real estate. Well, it's putting a lot of your eggs in one basket, right? Because obviously, if you do see a prolonged drop in the housing market, their compensation is going to go down. They could lose their jobs. And their, of course, investments could go south. So it's just thinking about your career and thinking about what the drivers are of those returns. And people love to invest, even they love to invest in the same industry that they're in. And that makes sense, right? Because they understand it more. At least they think they understand it more. But just remember that there are risks associated with that. So it is something important to look at. The other thing that's really important to look at, especially with what's happening right now, is your personal inflation level. So don't just think about money coming in, also think about money going out. And we like to talk, and we have to talk, obviously, about inflation in the aggregate. When we look at CPI, it's measured with this basket of goods. Well, that's the way the government needs to measure it. But just realize that you don't have the same life as everyone else. And there are different expenses and there are different parts of your budget that are going to drive how much you need to spend. So think about those factors as well and how that is going to influence you. And a simple example in that is just your housing. So if you own your home outright, things like interest rates going up probably matter a little bit less to you. If you are a renter, then of course increases in rent matter more for you. There's all sorts of different drivers. So think about that and think about how that influences the financial plan you're putting together. And then finally, of course, family is the other one, right? So everyone needs to think about dependents. So both dependents being children, dependents potentially being elderly parents, and what is their financial situation based on, and are you going to need to step in to take care of them? So it's making that whole holistic approach. So if you are working with an advisor, once again, as we said around the plan, make sure that this is about you, and make sure your advisor understands your life circumstances. Some advisors will, of course, as I said before, very quickly try to get from you to the actual investments and put together a portfolio. Make sure you take a step back and make sure they're asking you about those circumstances. A good advisor will, and they'll understand holistically what is going on in your life and what are the different drivers that are going to influence your financial future. And the other thing, the last thing, of course, is with financial advice and with your own plans that you're putting together, realize that there are many different types of advisors. And, some advisors, of course, are ones that will go and actually select the investments that go into your portfolio. That's where they are trying to add value. Some advisors won't touch that, and they'll outsource everything. And they'll try to add value through other things. They'll try to add value around the financial planning. They'll try to add value around potentially very specific situations you may have, whether that's estate planning, complicated tax situations, but just understand what the advisor, where their value is. So if you're going to pay that, $3,800 for advice, understand what you're actually getting and what you're looking to do. And also think about your own situation and where you think you can add the most value. So one way, of course, to add value is going in and picking the right investments. One way to add value is mostly focusing on asset allocation. So think about your own edge. And we talk about edge a lot. We talked about it on Tuesday. Think about where your edge is. And in some cases, it's investing passively, trying not to make stupid decisions. And that's probably enough. So just think about sort of where you can add value in that whole end-to-end process, and where you maybe don't necessarily want to play. And a lot of people, it's picking the specific investment. So they take a more passive approach. All right, so we got a couple, I just did something strange with the screen. Got a couple questions. Okay, so good question from Mark. I, of course, like your name. So he says, any advice on taking your partner on this journey when they're not as goals/plan focused? Mine would rather spend the $4,000 on other things. Yeah, listen, I think there's two sides of that. So, generally, we see if you're in a relationship, that one partner will be more interested in some of this stuff rather than the other. So I know that's the situation with my wife. So I am doing a webinar and she's at the beach. But I think in situations like that, it is important, obviously, to communicate that. You don't want to be in a situation where you're with somebody, and even if you're doing most of the sort of planning, investing side of things, and your partner has no idea what's going on, that's not a great situation to be in. And what I would focus on, particularly with this $4,000 on other things, is focus on the value that can provide for the future. So Warren Buffett, and I'm going to butcher the quote here, has this interesting quote where he talks about like a $30,000 haircut. And so $30,000 haircut, and what he's saying is that when he was younger, that the money he spent on a haircut, if he would have just not gotten his haircut and invested it, it'd be $30,000. He might have said $10,000. I don't remember what he said, but the point is obviously, to think about what that money means in the future. So if you're going to spend that $4,000, something that you believe is going to have a lot of value, that money that you're spending on the value, just like the money of stuff that you are saving and investing, is going to be worth infinitely more in the future. So I remember when I was younger, I always sort of talked about this, would you rather go out to dinner now, or would you rather go on a trip when we're 50? So I think sort of putting things within that context, and, saving and investing and getting financial advice to support you in doing that all of that is just delayed gratification. It's not spending the money, it's just spending it later. So I don't know, that's sort of what I focus on, but hopefully that's a little bit helpful. Yeah, so Sergey says, yeah, so he thinks that he gains a greater understanding and learns from his own mistakes. So that's good. We're all trying to learn from our mistakes. Okay, so Lisa's saying, is there a government website that can help individuals with preparing their own financial plan? You know, there are certainly, if you go to like Money Smart and things like that, there's a lot of advice out there in sort of picking advisors, a lot of advice out there on, you know, I guess just information on different investments. I have not seen anything that sort of has you go through and create a plan. That's what we've been trying to do at Morningstar, I will say, and a lot of the focus that we have. But yeah, I have not seen that. You know, I think that it's complicated, so people generally sort of avoid it. And we've gone down two sorts of paths. Like one, go get financial advice, and that's why the focus is on finding an advisor. The other path, of course, we've kind of gone down, and we haven't seen as much in Australia because of some of the regulatory issues. But you know, we've had this robo advice concept, which I think in general in Australia, I don't love many of the solutions, and I don't love them because they are very focused on risk tolerance. So basically what they are, and this is a way, of course, right? This idea of robo advice is a way of providing scaled advice in a country that clearly needs that capability. But I think the issue is, like, number one, the regulations are very onerous. So you have to get a personal advice license in order to do this. And then I think there's still too much of a focus on this risk tolerance, right? So the idea, once again, and they're trying to sell you investments. The idea is you go through, you quickly fill out this risk tolerance questionnaire, and I've done a couple of these. You fill it out, and then they say, all right, you're imbalanced. And then all of a sudden it's a portfolio solution. So yeah, once again, I don't think that there's enough time spent up front to actually create what I would call a sound financial plan. But thank you for that, Lisa. All right, so that's all I was going to cover. So unless there's other questions, maybe I will go down to the beach. But if anyone has any questions, you can send me an email at mark.lamonica1@morningstar.com. I will get to those tomorrow morning. But yeah, send through on emails. I hope everyone's having a good Thursday. Just one note of advice, or one advice. Next week, we're going to do two of these, what we're calling on demand. So basically, we pre-recorded them. We'll send them out to you. But if you do have any questions, send them on through. So anyway, hope everyone has a great day. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.